Welcome to this presentation on the role that corporate insurance plays in a firm's risk management strategy. Before we start, let me clarify that this presentation can only provide an introduction to the topic. It is not suited for any specific application. PRS Capital Solution is not liable if business decisions are based on the statements made without further, more specific advice. The motivation for creating this slide deck were discussions with some of my clients, insurance managers and corporates. I felt that the great work of corporate insurance managers should be better recognized in their firms. On the slide, I have noted questions they had been asked internally. Probably you have come across similar ones. Now let us see how we could answer them. The first answer here is also the first time we apply the approach described in the sentence at the bottom. We use the language of finance to express the value creation of insurance and risk management in general. The second answer will be illustrated by real-life examples. We will see the impact of at least partially insurable events like product recall and environmental damage on shareholder value. A proper answer for the third question is beyond the scope of this introduction. We will cover this more quantitative aspect of insurance management in another presentation. Slightly more general, we get to the following questions. What is the value creation of insurance from a corporate finance and an investor's perspective? How can you quantify it? How can you optimize the value creation? Which role has insurance among the risk instruments? Let me clarify that this is a presentation by an independent consultancy. It is not about insurance placement or broking. And I hope this presentation is relevant to your company regardless of its size, its ownership structure, or its legal form. Now let's look at the relevance of insurance for shareholder protection. Investors accept risks they can understand by following the information provided by the firm, as well as the media coverage on the company and its economic environment. Some of those risks you can find here. For example, the 5 forces of competition as introduced by Michael Porter. Those risks are also reflected in the share price, and if they materialize, then they do so over a certain period of time. For example, when digital cameras came up and threatened to substitute film, the share prices of photographic film manufacturers declined over several years. Summing up, this is the situation of a rock-solid company. Now, let's look at icebergs. You can see that risks which you deal with in insurance are usually quite opaque to investors. To which extent a company is exposed and protected against, say, environmental liability is hard to find out. Worse, probably not even the company itself knows. We've listed here a few of what we will call iceberg risks. So if you are looking for a striking description of your role in the company, you are the one who helps melting the iceberg risks. Risk modeling will help you getting an idea about the size of each risk, but we should never forget that in risk management we have 2 different types of uncertainties. The actual impact of risks, which we are aware of, might in general be different from what we've modeled. And then there are always risks of which we are unaware. Good risk management takes both into account. In the best case, you should have an answer if the company is confronted with a risk which no one had on the list. A typical good candidate for such an instrument is a credit facility, which should at least help you with liquidity issues if a risk materializes. Let us now have a look on the effect those iceberg risks had on share prices in the past. We compare 2 share price developments relative to their value of the first day of the period, which is the 100% value for each stock. Let me remind you that we use these examples to show the effect of some iceberg risks. It is not meant as a statement on the sophistication level of the company's risk management or insurance strategy. In fact, this would require in most cases confidential information. Here we see the share price of 2 companies hit by the same NatCat event, since they had substantial production capacity in the same region. As you can see, they were not able to supply these products for quite a time, in fact for much longer than a year. So, why does share price recover at around day 100 for the company in yellow? First, the company was able to raise production levels in other factories. Second, since those two companies hold a very high worldwide market share, the price per unit of those products increased substantially, which set off the loss in production volume. It looks like the yellow company was a bit quicker and more successful in coping with the situation. You also see that there's a substantial rise of the yellow curve after day 200. Frankly, I don't know exactly whether this is attributable at all to the aftermath of the NetCut event. I left it in to give you an idea of the overall volatility. Summarizing, we see here the effect of an iceberg risk on share price over a rather short period of time. Here, the share price of a company who caused substantial environmental damage is plotted in blue. In yellow, we show a competitor who was not affected. We see that the blue share price fell by over 50% within some 50 days. The comparison to the competitor shows that this is largely attributable to the environmental damage. We also observe that the difference of the share prices stays for the shown period. The underlying reason is the loss of reputation and, worse, the selling of assets under pressure in order to fund the claims. It is fair to state that insurance cover was not substantial here. The main reason is that large claims in that industry are almost beyond payable for insurers. In this case, instruments providing liquidity in times of stress are one of the few options. Let us now look at a risk which is relevant for manufacturers of any size: product recall. As you can see, for the blue firm, that ended in insolvency, while a competitor did not have the quality problems and is still an important player in this market today. As you can see, the actual size of the problem became only clear over a period of several years. The last example shows the impact of nationalization. We compare two mining companies. You can see even before the event that both share prices are quite volatile, as they largely follow the price development of the produced commodities. The impact of the nationalization of a substantial part of the company's assets is clearly visible. In fact, the firm never recovered from it. Let's summarize some observations. The impact of iceberg risks can be short-term as well as long-term. In some cases, insurance can play a vital role, in others not. It is also a question of the absolute size of the risk. It simply can be too large for the insurance industry. Let us now look at a larger set of instruments to build a resilient risk management strategy. Basically, there are 4 instruments of risk management: risk transfer, mitigation, avoidance, and retention. You find on that slide some features of each instrument. This is not exhaustive, and there's intentionally no order or classification of the aspects given, as the application is very solution-specific and determined by many aspects like the internal risk culture, budget constraints, overall strategy, to name a few. Let us look at risk transfer with insurance as the most prominent example. Often, insurance provides the fastest and cheapest solution. An advantage as well as a disadvantage is that usually no structural changes are required. The issue here is that an entity's bad risk management gets subsidized by entities with good risk management. This is the case if the master program's premium is allocated by sums insured or similar measures. Units with consistently high loss ratios then lack the financial incentive to invest in risk prevention. The result are ever-increasing insurance premiums for the firm as a whole. In contrast to transfer, risk mitigation is very problem-specific, of course. Consequently, the implementation will require more time and money. Avoidance is in that aspect similar. Both have also the project risk in common. Avoidance is a much less exotic consideration as it might appear at first. In particular, those companies who should have a very high expertise in risk management, insurers and reinsurers, have often withdrawn from underwriting certain kinds of risks in some countries or even on a worldwide level, and you experience the changes in underwriting policies every renewal. And retention does not mean we are complacent. At least, we try to ensure minimum requirements like liquidity and business continuation in the case a retained risk materializes. A captive can be a very cost-effective way to organize the higher frequency loss burden in that case. You might have guessed it by now. The main message of this slide is, no instrument is perfect, and any such instrument needs careful consideration. It's a message we feel you will not get in that clarity from your usual partners. For example, your insurers or brokers would most likely not be that keen on talking about alternatives to insurance. In fact, those alternatives often have no external voice at all, since nobody's revenue is increased if you decide, for instance, to avoid a risk. Like in music composition, any solution requires awareness of possibilities and comprehensive knowledge of rules, but at the same time the courage to break or extend such rules too. We now apply these instruments in a three-step approach. First, we identify all key risk drivers. Again, this is very company specific. By the way, this example shows that risks can be relevant even if you might not be able to pronounce them. At this point, we should probably briefly talk about modeling. It is more an appetizer. We do not explain in this presentation how we actually model the impact of each risk. Ideally, you would have loss frequency curves providing a probability for a loss of a certain size or worse occurring. If you want to get to really meaningful results, you would actually aggregate all those loss frequency curves on a corporate level. We will publish a presentation on this very important part of risk management at a later point in time. Assuming for now that we have modeled each risk, we then express its impact on the financial statements, the balance sheet, profit and loss account, the cash flow statement. From the financial statements, we can then derive how your individual key performance indicators are affected. As we have seen in two of the examples we've discussed, the impact of such a shock can be substantially longer than 1 year. Imagine you have a plant which burns down in year 1. Then you will have a reduction in assets in year 1 affecting your balance sheet, a loss of income affecting your P&L, and a loss in revenue affecting your cash flows. Since it would take years to rebuild it, you most likely also have reduced revenues in the following years, which also need to be taken into account. However, that is not the only reason why the impact should be studied over several years. By doing so, you can also investigate the consequences of different reactions to the shock on the financial side. For example, in year 1, the company has probably the option to reduce dividends or, instead, to increase debt. Any of those actions would affect the consecutive years as well. Our experience shows that this kind of thinking can spark very fruitful discussions between insurance management and corporate finance functions like treasury. If we have properly assessed the impact of a certain risk, it's time to think how to manage it. As you surely agree at this point, the variety of risks, the instruments and the application is infinite. So it does not make much sense to give you more than one example purely meant for illustration. Let's take the scenario of a severe accident in our plant in Rotterdam. Our assessment has shown that this would lead to substantial losses due to business interruption. So we can use insurance to increase the cover and thus to lower the risk. However, at one point we reach the limit of the insurer's risk appetite. And, of course, we did so far nothing to prevent the fatalities. Therefore, we also need to spend more on risk prevention to mitigate the risk. It will also help us in our future renewal discussions. Implementing the risk measures will take years. Since our assessment has shown we have to reduce risk quicker, we suspend the part of the protection which requires processes we can't sufficiently control right now. The costs for this measure are mainly the loss in revenue. We end up with a substantially reduced exposure. In order to save insurance premiums, we use our captive to retain part of the risk more cost efficiently. Last but not least, we increase our credit lines so that we can finance the necessary emergency measures and cope with the loss of production in the case of an accident. Let me now summarize what we have discussed. We have seen insurance as a great and flexible tool of corporate risk management, provided it is applied as part of a coherent risk management strategy with all other tools available to the firm. In view of the complexity and importance of the topic, the insurance manager shapes the risk management significantly, helping melting the iceberg of corporate exposures. We hope you have enjoyed this presentation. If you are a non-expert, you might have gained an overview and a certain appreciation for the work of insurance managers. If you are an insurance manager, we hope you have found some aspects relevant to your role. It is an intellectually challenging and creative work which is so vital to the company and all its stakeholders. We at PRS wish you every success in mastering those challenges every day.